Welcome to the Property Investing Roadmap podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision. And they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Well, welcome back. There's so many avenues for investing in today's market. Various levels of risks and returns. We've got cryptocurrency, stocks, bonds, managed funds, art, lots of other things out there that some of us probably haven't even heard of. But of course, this is a property investment podcast, and today we're going to be talking about why property is such a great asset to invest in, why it stood the test of time. And to help me unpack it today, I've got Mark Casey, who's a property acquisitions specialist from Momentum Wealth, been with Momentum Wealth for well over a decade. Mark, great to have you here.
Thanks, Damien. Great to be on board.
So, look, you've got a long history personally, as well as done some great things for clients over at least the decade you've been here. But tell us a bit about your background. I know you weren't always in property, that you had a different career before you got into the property market, and tell us about your property investing journey.
Thanks, Damien. So my journey started back, I guess my passion for property. Mum and Dad were property investors. They had a business in the country. They had a couple of properties in Scarborough and 2 in Curragh. They started their investing journey back in the 1970s, 1980s. When I finished my degree at university back in 1991, just started working at Deloitte. They were looking to sell a property, so probably accidentally for me initially. They sold off a third share, just you might remember back in the late 80s when interest rates got to 18%.
Yep, I was still in uni like you, but it was expensive time for our parents at the time.
Yeah. So they introduced me to property. They said, "Do you want to buy a third share, Mark?" And that was my initial foray into property. Back at the time, Scarborough, Stanley Street, which you'd know, bought a third share for $22,000. So market value was probably $60,000 then. Now they're kind of mid 5s to 6. So started there, then bought my second in 1995. So blended properties, focused on, and then after that moved into mining, where I sort of did a lot of research, reading, went to a lot of seminars, built up my knowledge, and then got into properties that had more land content, land value. So my journey grew, started, I guess, with that early beginning, which is probably thanks to my parents, but certainly developed an early passion for property.
And did you, that one that you bought from your parents, did you hold that for a long time, or did you end up selling that?
Good question. I've still got it.
You still got it?
So Dad, fortunate to still have Dad with us. He's 89 now, but that's his job to look after that one. So he actually knows the property management laws pretty well, Dad, but it also keeps you alert as well. So still got that. So it's been a good just to watch how that's grown and changed over time.
And it's interesting over that, and Mark's talking specifically about some assets that he owns in the Perth market, but doesn't matter where you are in the country, does it? It's and Perth has seen some up and down cycles, and there was probably a decade where it went nowhere. But just showing that time in the market, just over 30 years, you've had that investment property, and it's I gather it's more than gone up nearly 10 times between what you and your family owned.
Absolutely, yeah. Well, the first few years I actually held that asset. It went backwards, and Mum felt a bit sorry. She actually gave me $2,000 back, but I copped that from my brother. But yeah, so it's been probably the learning experience from that first property taught me a lot. And just to get started, I guess, into the market.
So why did you tell me what you liked about property, and what do you see some of the things our clients really like about investing in property? Why do they like property as an investment category?
It's a good tangible asset. It's something they can see, feel and touch. They can add value to it. They can influence the asset. If they invest in stocks, it's hard to have an impact on Westpac Bank or BHP, whereas with a property they can start small like I did, do renovations, increase the rental yield. Obviously, if it's a bit of land, they can develop it. So it gives them a lot more scope for improving value to the asset. And it's easy to understand, I guess, for an investor as against crypto or shares.
I think that's an important thing, isn't it? When you own a property directly, and particularly if it's freehold, not strata, you're really in control of your own destiny, aren't you? In terms of you can value add to that property, you can paint it, do carpets, whatever you want to do, which is something I think a lot of people find appealing, is that they can see it, touch it. You mentioned the tangibility, but also they have the ability to control value add. Whereas, of course, as we said, with shares in a company, you really have little impact, do you?
That's right, yeah. And probably my own journey, as my knowledge grew from buying a unit to buying development sites and developing them, also renovating properties, just your own influence on the property is a great benefit.
You mentioned there your first property went backwards, and thanks, Mum, for helping you out there. Yeah. But we've also seen across the country, if you go back over that 30 years, every capital city has seen a downturn at some stage. And but one thing I like about residential, and perhaps you might talk about your experience, is that even Perth had that really long downturn, but over the long run, it's always recovered and gone higher. But even when there's a downturn, they tend to be a lot shallower cycles than the stock market, for example, which can drop upwards of 50%. What's your experience?
That's right. I think property investing, there's lots of different strategies, but it should be a medium to long-term strategy, and then holding through different cycles and leveraging off that growth. A lot of people, I guess, if you become impatient and hold it short-term, that's where you can become unstuck. But you're right, every capital city's had its different cycles over that period of time, and I've been fortunate to invest through a number of cycles and seen the downturns in between, but the upturns have always been higher than the previous downturns.
And you mentioned earlier on, Mark, about your learnings about the land value, and maybe just tell our listeners why that is so important when you're looking at an investment property. I know that's what you do all the time when you're looking at it for clients in your role as a property acquisition specialist. Tell us why land value is so important. That's
a great question, Damien. Probably took me the first 10 years were more blended properties, but once I'd read a lot, understood a lot more about property investing, and as we do for clients, we target 50% land value, but the intrinsic land value helps the asset grow. So to get the capital growth over the cycles, if you target the right properties, you get that compounding growth, which is what we're after. So as property investors, you want the yield, but also the capital growth over the long term is what you're really looking for.
I think there's a famous quote, they're not making any more land, and certainly out in the middle of the desert there's plenty of land, but in our capital cities particularly, and we've seen that in every major capital city across the country, haven't we? Look at Sydney, the extraordinary prices there, particularly around the harbour area, simply because there's not enough supply. There's only so much land, and and when the strong demand comes in, simple economics 101, demand outstrips supply, and prices go up. So when you're looking to buy investment properties for clients, I guess it's not just the land value. You're looking at how much land is available in the area, aren't you, to make sure that there's not going to be a lot of supply coming into the market.
You're right. We look at a lot of factors. We look at the intrinsic land value. We do make sure there's not a lot of land, available land to be developed in the area. Look at infrastructure, connectivity to the city. But those areas that are already built out obviously have greater capital growth and have got amenities established and are generally faster growing areas.
Mark, I want to talk about cash flow from residential property, and how important is that to investors to get that regular income stream?
Great question, Damien. You and I are both accountants, so it becomes a little bit more natural to us. But an investor, anything they buy, they want to understand the cost attached to it. A lot of people go into property initially, obviously their own home, a little bit more emotionally. As an investor, you've got to look at the underlying holding cost over time and make sure that fits within your own risk profile. So we look at people to work out whether they're a blended or a higher risk client in terms of value and growth, but that's generally dependent on their income. So someone on a lower income should look more for a blended property, better yield. The growth is good, but maybe not as high as a larger block with an older home. But what you want to do with property is make sure you've got the endurance to ride out the cycles. Not to look at it as short term, but make sure you're comfortable, pick that right property and make a long-term decision. And you can get in and out when you want rather than short-term investment decisions.
Yeah, and you mentioned that earlier, the one you purchased over 30 years ago, you still own. And I guess that's so important, isn't it? Because it can be frustrating. Like, I'm a property investor, you're a property investor, and I love investing in property, but with the residential ones, some months you go, gee, I'm not getting much here. All the costs of the hot water system breaks, all those sorts of things. And I guess that's why it's so important, isn't it, to understand how much cash you really have available and whether you've got the stomach to where some of those months that the cash flow might be a bit lower.
You're exactly right. But that one, going back to 1991, the yield might have been 5 or 6% when I bought it. It's probably up to 30% now. So the power of time in the market, the yields do grow, and they help you hold on to other properties which are costing you more. So it is a medium to long-term game, but critically picking the right property, but understanding the cash flow position as well.
Now, Mark, you're still a very young man. I won't give away your age, but tell me about now that you've got to, let's say, more than 45. I won't. A
little bit over
that. Little bit over that. What are you looking at now from your retirement perspective? One day we're all going to retire, I guess, eventually. What are you now looking at in terms of continuing to build out your portfolio so that it'll give you that income for life?
Yeah. So over time, my portfolio has changed. The assets that I've held for longer, the yields have increased. But as I've gone through my own journey, probably moving into my 40s and now 50s, looking at more cash flow, I guess, to blend into the portfolio. I do personally look at my overall yield, but I've moved into some commercial syndicates. So they're more, I guess, not time as intensive as residential property. They allow an investor to go into a larger asset category and probably buy assets that you're otherwise not exposed to individually, so you can get into a lot bigger assets. They're a good blend for an investor as their portfolio grows from resi to commercial through the life cycle.
I think that's really important. Look, and my philosophy is residential is a great place to start investing because you're earning an income generally. You can benefit from negative gearing, so you get some back on your tax from any losses that you have, and you're obviously factoring in that you anticipate and hopefully get pretty strong capital growth. But when you get to retirement, most residential properties in Australia, maybe if you had no debt, are going to net 3 to 3.5%, and in some capital cities it's going to be less than that. Whereas you mentioned their commercial, you can potentially get 6%, and that could continue to grow. And I think that's a really fundamental, important point, is that when we're looking to invest, residential is where you want to start, but it's pretty hard to, you've got a pretty good sized portfolio, Mark, as I do, but it is still even then hard to sustain an income for life, isn't it, if you just got residential?
I think if you can get a blended portfolio, you put yourself in a better position. I suppose the other thing to look at too, Damien, is your net asset position. So as you do move close to retirement, you can gradually sell down some properties, pay off some of that debt. But I think for all investors, it's good to continually look at their own strategy and look at how they build their portfolio, but to probably build a more balanced portfolio.
Mark, in terms of, I want to talk about a case study, one of your clients that, and you've helped hundreds and hundreds of clients over the many, many years. So it was, we won't share their surname just for their own privacy, but Russell and Amanda, I want you to tell me a bit about how you've helped them grow their property investment portfolio. So
Russell and Amanda came to me. They had their own home, bit of equity in that, but they're kind of foray into investing. We went through their risk profile strategy, and they had a good income. They had an appetite for strong growth. We bought them one in the northern corridor of Perth, in Hillridge, which you'd know, adjacent to Whitford Shopping Centre. So when we bought it, it was draft 2060, Damien. So it was in the early stages. The market hadn't really reflected the value. And fortunately too, at the time, I guess some agents are more attuned to what different zoning has opportunities there. So that actually went through and became an R2080 mixed-use commercial. So that asset we bought back in 2012, and now we bought it for $535,000, so it'd be well over $1 million now, Damien. So the asset itself was probably yielding 5 to 6%, but the asset's doubled in value. That allowed them to go on and expand their investing journey. They went on and purchased, through me, a subdivision site in Warwick, which we basically kept the house. Russell's quite handy renovating. We subdivided off the lot and then sold the land. And then their portfolio has advanced again. They've kind of gone interstate and bought and developed over there. They've done that a couple of times, so it's good. So their portfolio equity growth plus the cash flows allowed them to expand.
Look, I think it's great that they got out of their home state, and everyone who's building a large property portfolio needs to think about that and on their investment journey, buying not just in your own backyard. So now they've built up quite an investment portfolio, and but they were aggressive equity builders as clients, weren't they? And some of those properties, the rental yields won't always be as strong, will they? If you're buying something that's nearly land value and you've got an old house on it, just tell me about what clients would expect. It sounds great in theory. I'll buy a development site and I'll make a lot of money, but on the way through, the cash flow is pretty brutal. Do you want to just tell us your experiences from not only your personal experience but clients in owning potential development sites?
That's right. I suppose if you've got the income, you can hold the higher cash or holding cost attached to the development side. But I suppose even that site, Damien, the Hillry's one, the yield's improved a little bit, but compared to the market value of the property, the yield looks lower now. Again, it comes back to, I guess, selecting the right asset category for that individual client to make sure they've got the right cash flow position to hold on to it.
Mark, you're a chartered accountant like myself. One of the things I think that people get confused about in property and why people sometimes make silly decisions is they go, oh, well, I'm going to negative gearing, it's going to save me all this money, so they pay less attention to the importance of cash flow. But you and I know, putting aside depreciation, when you lose money on a property, it's only going to work if the capital value goes up, isn't it?
That's exactly right. You need to select the right properties, otherwise it's a one-way formula. So that asset selection is critical up front, and people can tolerate a holding cost providing they can see the ongoing gain. I guess sometimes people become a little bit blind to it. If the market's moving, they think it's always going to continue. And obviously, like we've discussed, there's different cycles where markets go through that growth spurt and then go sideways for a little while and continue on.
Now, Mark, you've done very well out of property, and but of course, like all of us, I'm sure you've had some ones that have done much better, and you might have had, hopefully not too many bad ones. I've had a couple. But so tell me about some of the best investment decisions you've made, and maybe a lesson you've learned from a not so good investment decision.
Sure, thank you, Damien. Certainly had some great experiences in property, and I've had a few that I've learnt from along the way as well. I can probably share a couple, if you like, first, where I've learnt from the experience. I've done a number of developments, as you know. One I did back in Belga, bought the site back in 2004, developed in 2008. What I learnt through personal experience, and obviously we help clients with, it's not always the maximum yield that is the right strategy for a property when you develop it. So that was a corner block, had a corner truncation. So as you know, corners, you get the add back. It was an 865 block, R40. I bought it thinking it was a triplex. It was actually a quad site. The building broker said, Mark, you can put 4 on, which we did. We did double story. A lot of selling agents at the time said, Mark, you're overcapitalising. I guess time is your friend in property. So those properties now have done well, but initially did overcapitalise. I've sold 2 and obviously made a little bit, but not a lot on them. But the other 2 I've hung on to have done quite well. So it's important to look at your asset and what you're putting on there and get the right development scenario, which we help clients with. And
just on that, just for the listeners, so Belga is a rejuvenating suburb, but historically it has been considered fairly lower socioeconomic, hasn't it? So,
absolutely.
So 2-story, the agents are coming at it saying, well, people won't have the budget to spend that money, I guess is where they're coming from.
Right. Yeah, it's only 12 kilometres from Perth, so it is fairly centrally located. It's had a bit of a mixed background, like a lot of suburbs. It's changing. That's sort of on the Westminster border, so a better pocket. But you're right, it's sort of more suitable for single, but there are a few more double stories popping up now. So just to move on to some good experiences or what I've learnt. Property investing, it can be a bit of a rocky journey, and you need to build your right team around you. I sort of did a lot, I guess, in the first 10 years personally, while I was working, reading, going to a lot of seminars. But as my own journey developed, brought in the team, finance brokers, acquisition specialists, like you're saying, going interstate. I have purchased interstate, bought back in Melbourne in 2006. You'd know Melbourne pretty well, being from Victoria. North Frankston, which is probably not too dissimilar from Belga. It is a bit of a rougher spot, but going through a lot of rejuvenation as well. Another opportunity which I missed, the sliding door moments to sort of make a decision or not to make a decision. Back in 2010, you might remember Sydney and Perth were almost on a par. done pretty well in the Perth market, was focused on a lot here, did engage a buyer's agent over there, but didn't follow it through. So it's one of those fish that got away, if you like. Was a good opportunity, but just didn't follow that one through. So you do need to follow your decisions through.
That just while you're on that topic, that triggers sadly a bad memory in my head. I'll never forget in 1998, I was in Sydney, and I could have bought in Bondi, right overlooking the ocean, a property for 1.5 million, which was a decent chunk of money back then. Now it would have a 20 in front of it. So I don't. You've just scarred me, Mark. You've brought up those repressed memories. And sometimes it's the ones that get away, isn't it? You go, I wish I'd done that.
It is. That's right. There's always those opportunities. I was looking, I think, in Alexandria, which is quite close to Sydney CBD. You probably know that too.
Yep. Yeah.
So I guess the other thing is, in terms of pushing your portfolio ahead, you need to kind of try to block out the noise. Sometimes you'll get people saying, don't do that, do this, do that. You've got to do your own research, make your own decisions, and then make a decision and proceed with it. And the big thing too, I guess, is buy when you can buy. A lot of people ask me when's the right time. In terms of buying, it's good to move ahead and make sure you do make that decision, because time is money. And like we said, that the ones I've still got, which I bought in the 90s, have done really well. And then just to wrap up, the power of leverage, which a lot of people buy one, but then to build that portfolio, you really need to tap into that equity, which is a little bit more of the understanding. That's where having that team around you, the finance brokers, the specialists to help you build that portfolio, is the compounding power of property.
And that's exactly right, Mark. Well, thanks very much for joining us. You've got some incredible knowledge from such a long time experience, not only working for clients but your own success in property. So thank you again, and thank you to our listeners for joining us. I'm just going to give you a little bit of parting advice today, and I'll talk around the pub test. Now, you often hear this in politics that will that pass the pub test, and will that pass through the average person? But one of the important things about any investment is that you can explain it succinctly to your friends. And look, there's lots of weird and wonderful investments out there, and occasionally they go pretty well. We all know cryptocurrency, it goes up and down a lot, but it is, if you got in early, that's done well. But I still can't explain that to my friends at the pub, so I've never invested in that. Maybe that's my silly mistake. But the one thing about property is that everybody understands it, at least to some degree. They understand it's a place where, particularly residential, somewhere we've all got to live somewhere, and that's one of the great things I love about investing in property. Certainly in Australia in particular, where we've got strong population growth, there's always going to be that strong demand for people. More people come into the country simply means more demand for property. And while it's not risk-free, there is always risks, and as Mark and I discussed today, it can go up and it can go down, but historically the cycles are much shallower than other investment classes. You very rarely, if ever, would see a 40-50% decline. Certainly in the capital cities, mining towns can be a little bit slightly different to that. So that's a great thing about property, is that it's something that most people can understand. And of course, there's 27 million of us in Australia. We've all got to live somewhere. So thanks everyone again for listening. Look forward to being back with you soon. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Today's guests are representatives of Momentum Wealth Property Advisory Proprietary Limited, licensed real estate and business agent in WA, RA 82976.